How's it going, everybody? Welcome to the Hot Corner Live Strategy Session. I am your host, Steve Strazza. I'm the Director of Research here at All Star Charts. We do this every Wednesday at 1 o'clock. Basically, we're going through all of the hottest, most significant insider transactions of the trailing week. We do a little bit of macro up top of each call because I just can't help myself and things are always moving. There's always important things to say and discuss. Drop a question, comment, say hello, whatever. Talk to me about how you scored on golf yesterday. In the chat, I am monitoring the chat. We're going to try to make this more interactive going forward. So I am trying to pay attention here. Before we dive in, nothing that we discuss here today constitutes any solicitation to buy or sell any security. This is all solely for informational purposes and not to be construed as investment advice. If, God forbid, you want to read more about this disclaimer, go to allstarcharts.com/terms. Now for the good stuff. Just when we thought it was over, right? What happened? We had Silicon Valley Bank, we had Signature Bank, we had Silvergate, early March, second week of March, I believe. Credit Suisse trickled in, I think, early April? But then it's been about a month. This month right here, in this blue, right? This bearish coil here. These banks had the initial flush. This was Silicon Valley Bank up here, right? Flush lower. The entire banking space. Any troubled regional banks looked like this. Then we went sideways for a month, right? We were all sitting around saying, okay, was that it? Is it over? The bank's going to make it out of this thing, okay? Or at least the ones that are left? Well, as chartists, we had to look at this pattern, continuation pattern, right? And assume that the resolution of this coil here shown in blue, I'm going to call it a bearish pennant, right? That's a bearish continuation pattern. Nonetheless, as trend followers, we have to assume that this was going to resolve lower. Why? Because continuation patterns tend to continue. They continue in the direction of the underlying trend, which was definitely lower heading into this coil. And there you go. You have your resolution lower. These patterns are everywhere right now. I've been talking about them. I've been so obnoxious about them for a month now. And basically what I've been saying is if more and more of these resolve lower and look like FRC, First Republic Bank, does here, I find it hard to believe that financials as a group are going to be holding our risk level. And by extension, if financials can't hold what is a very, very critical level of interest at the prior cycle highs and the financial crisis highs, I don't think small caps and broader indexes are going to hold either. So the way this is going now, I think we want to, be strapped in and looking for further downside and heightened volatility from the market. Let's put this all into perspective. It's easy to go in and say these blowups don't matter. They're not going to impact the indexes. Because these companies, I get it. They're $1-2 billion time they blow up, but these are $20-30 billion banks not long ago. The banks that are blowing up, you look at like First Republic chart, that's in like a 90% drawdown before it blows up. The writing's on the wall, right? So there's been a lot of cap lost already. I think we have to be careful to not breeze over this too casually. This is a very big deal. We haven't seen these kinds of bank failures since the financial crisis, right? And one could even argue that even then, a string of so many big ones, in a month and a half's time, is in some ways maybe even worse than what was happening in the financial crisis, where we had a bunch of much smaller banks blowing up. But that's where we could be headed. I genuinely believe that bank runs are no joke. There's really no way to protect against them. I think these guys are probably next. This is Pacific West Bancorp. I don't know what they're doing over there on the West Coast, but they can't seem to figure out how to stop blowing up their banks. So here is PACW breaking below its financial crisis lows, making new all-time lows. Maybe this one goes into FDIC receivership by the weekend, and its assets are sold, by Monday, just like we saw with First Republic coming into this week. The question then becomes, right, how many banks could blow up and it still doesn't matter? Or how many banks could blow up and we still don't see some sort of flow through to the broader market, right? Or other risk assets. Because as this is happening, as these banks are blowing up, three big ones now. First Republic was bigger than Silicon Valley. This is measured by their gross assets. As more and more of these blow up, eventually it's going to have to matter, I would think, right? So maybe the Fed's done hiking. The damage is probably already done. Maybe we get another period, where the banks could take a breather and try to regain their footing. But if we continue to see this domino effect play out, here's what Pac West looks like now. I think eventually it runs through, hits financials, hits things like the Russell 2000, the value line. And I think we're probably, asking very different questions a week or two from now if those levels are broken, right? By that, I mean we're taking a far more cautious approach than we are right now. Because right now we have such a dichotomy taking place in markets where home builders are making new highs, new all-time highs in some cases, and then these banks are hitting new all-time lows. I don't think that can go on forever. That divergence clears itself up sometime in the near future. It's just a question of, do the banks catch up and catch higher, or does everything else catch lower? So this was really, oops, what am I doing here? We had enough banks blow up that finally we forced this downside resolution in regional banks KRE, right? Because it's not just like a bank blows up and then that's the impact on the index. It's when another bank blows up, then you see selling pressure for the whole group, right? So broad selling in the banks all week. We have a Fed decision in literally 48 minutes. Maybe that's a catalyst for further selling pressure and some of these bearish continuation patterns, right? Because each bank looks different. We're going to rip through a ton of them in just a minute here, and you're going to see what I'm talking about with all these coils like I have drawn here in blue. But for the most part, what's important here is that the regional bank index and the big bank index, the spider banking index, KBE, are resolving lower. I find it hard to believe that those downside resolutions are going to play out and experience follow through. And the big six bank index and financials themselves, right? So XLF is holding this key level here around 30. So this chart, what is the takeaway? As you go on down the cap scale, and that's really what we're doing here, right? From a banking perspective, we could break these banks into so many different groups, and we do, right? This is the big six bank index, which are your big boys. What should be okay through all this is, if anything, they're probably taking on more business. You could argue it's just a sector-wide problem, right, where these banks are effectively being socialized and someone's going to have to pay for that. That's probably the big bank. So I think it caps the upside for the entire sector going forward. In my opinion, banks are becoming regulated utilities. They're going to be very boring stocks going forward. Maybe they even lose that kind of risk-on appeal or risk-on information that they have given us throughout history. But we're entering a strange place now, right, where banks are really becoming these like quasi-governmental entities. So anyway, back to the point about this chart, starting and moving clockwise here, we're going from large to small, right? Kind of clockwise, no. So starting up in the top left, big six bank index, that's your big boys, by far the strongest. Then you have the banking index, KBE, also stronger than, the smaller banks. Then you have the regional banks, and we could even break the regional banks up into the super regionals. And then this broad index, KRE, I think has over 200 holdings in it. Then we have the community banks, which are the really little guys, right? And this was the tell. This was the signal. If you look here in the bottom right-hand corner, right? Community banks never even coiled. So if you look at KBE and KRE, right? We had this period of consolidation where this bearish continuation pattern formed throughout March and April, really throughout April, right? In QABA, community banks, it's just been a straight shot lower. This thing never even tried to catch its footing, right? It's just absolute collapse. So now we're seeing the regionals follow, the banks follow. Do the big six follow? If the big six follow, you got to believe that financials are breaking. Here's your super regionals index, right? This is a custom index of all of the biggest, most important regional banks that would come after the big six in terms of order of importance, right? So you have this distribution pattern playing out. And this little consolidation here, violating these prior cycle highs. Now we're back at these 2018 lows. If those go, I think you only got the 2020 lows in play, right? Nonetheless, now that the earnings blackout period for Q1 earnings is behind us, and all that means is in the weeks or so ahead of an earnings report, executives are locked out. They can't buy or sell. They can't transact in their own stock. Makes a lot of sense, right? They know the numbers that are about to be reported. The public doesn't know them, can't trade on them. Once the report is released, the public then has the information that those executives had, and they are no longer blacked out. They're able to come and transact in their own stock. As soon as this period's blackout period expired for a lot of these executives, they just rushed to the market and bought shares. So Lakeland Financial Corporation, that's LKFN. US Bank Corp, that's a super regional. That's as important as they get outside of the big six. That's USB. FB Financial, FBK, Texas Capital Bank shares. Looks better than most. We'll get to it in a second. That's TCBI. This was 2 days ago. Now, this is from this morning. This is all of yesterday's filings. Look at all the regional banks. TCBI again, Zions, Simmons First National, Ameris Bank Corp, Prosperity Bank shares, FB again, Bank of Hawaii, Farmers National, Old National, First Financial. They just keep hitting these stocks, right? So management is trying to show a vote of confidence, and they're buying decent amounts, right? Nothing to laugh at here. You got over $1 million in purchases from the president of Zion. TCBI also on back-to-back days. TCBI, yeah, it looks like all the directors are coming out and buying TCBI. We'll see, right? We'll see. TCBI is one of those energy banks, though, and I would want to be extra careful around the energy banks right now because they could have a double whammy coming their way. And we will talk about that in a second. We're going to get to energy. This is the level. This is the line in the sand. Spider Financial Sector, the sector Spider Financials, XLF, $30, really 30.50. Great financial crisis highs, 2018 highs, 2020 highs. If we break this level, the broader market's coming under pressure. And again, I would say the path of least resistance is no longer higher for stocks at large. I would say that we are probably no longer in an environment where we want to be looking for stocks to buy, not sell. I would say we're in an environment where we want to sit in our hands, be on the sidelines, monitor whatever kind of follow through that we get before jumping back in. Everything changes for me below 30. When I think of, okay, do we break 30? You know, because financials have been incredibly resilient as a group despite the pain from the banks. But when I look at this chart, right, this is the big banks, KBE, and then the really big banks, big six up top. We never even got above those pre-financial crisis highs in these indexes. The banks never got it done, right? So financials breaking, XLF breaking, would just be them catching lower and confirming the price action that we're seeing from the banking indexes. Banking indexes never confirmed, never got this huge base breakout like we did get here in XLF. So was this the false move? Does this fail? This is just now a massive top and we're back in the box like the banks have always been? I think that makes sense. If that happens, right? So here's XLF zoomed in. If that happens and we're below this 30-50 level, well, goddamn, look at how similar the Russell 2000 small cap index looks to financials. There's a ton of financials in there. This index has more banking exposure than really any of the majors, by far. If financials go, Russell probably goes, things like the value line goes. What does that tell us? The median stock goes, right? We're losing the market in a way. I think the market loses those prior cycle highs from 2018 and 2020. The Russell 2000 index, in my opinion, is the best representation of the broader market of any of the indexes, right? There's too much cap-weighted exposure in NASDAQ, S&P 500, and then the Dow, it's just price-weighted and doesn't have the most important stocks for me, right? So the Russell 2000 is really showing me what most stocks are doing. Most stocks are back below these prior cycle highs. Again, we're having very different conversations. It will warrant a far more cautious approach. I don't like this either. This is Schwab. Largest retail broker in the United States, maybe the world. Talk to Chuck. Chuck's been buying shares, but the market doesn't seem to care. If we break these .com bubble highs around 50, 51.50, you can't touch this. Can't touch this thing. If you want to step in and buy it here, above 51.50, fine. But with the price action I'm seeing in this sector right now, and with banks, exploding left and right, you're playing with fire. You're playing with fire. So if you want to step in and buy Schwab here, go for it. Your stop better be no more than $1 south of where we're trading right now. You want to protect these kinds of trades as well as you can. And even then, there's event risk, there's headline risk. You could wake up one morning and see Schwab down 10%. There's going to be nothing you can do about it. It's going to blow your stop. Right? So for me right now, I don't want to touch any of these things. Let's talk about why. Let's look at some of the banks that insiders are actually coming out and buying right now. Typically would be a buy signal for us, right? But I'm not agreeing with what I'm seeing from the price action. So here's FB Financial Corp. We got a nasty top here. This is a classic distribution pattern. We broke lower back in March, it looks like, on the Silicon Valley Bank news, and this thing's just been dripping lower ever since. Now we're taking out the 62% retracement. The only thing we can look to for support now is those 2020 lows, and they're another 50% lower from here. Right? TCPI looks better than most. If you want to come in and buy it here, hope for some sort of like oopsie failed move back above these pivot lows. You can define it here at 47.40. You do have a gap from back in 2020 at this level. But again, this is a top. And it looks to me like this is a bearish flag coming at the lower bounds or the breakdown level of this top. And the resolution here doesn't just mark the resolution of this short-term bearish continuation pattern, but this longer topping or reversal pattern, right? And again, that would be, this is a bullish to bearish reversal playing out, and it would suggest further downside. So below 47.40, can't touch TCBI. Again, I'm discussing these and giving you guys these levels because the most significant insider transactions, and by far most of the insider transactions and filings that we're seeing past month and a half, are all in these regional banks, right? So we got to talk about them. Just because insiders are out buying them, listen, you got to follow price, right? You got to listen to the message of the market even more than an insider, always. And the trend is just lower for these guys. So here's East West Bank Corp. I don't know if they're East or West, but it's really the West banks that are having all the issues right now. So that's an interesting name. CFO's out here buying shares, I think last month. Bearish continuation. Again, okay. Uptrend, topping pattern, completion of the top on the Silicon Valley Bank. Volatility from March, bearish continuation pattern at a logical level. We got those pre-COVID highs right here around 49.50. Now resolving lower. Again, no support down here. I could draw some lines over here like these pivot lows from 2020. But what's that, $30? Can't touch it. Wintrust Financial, WTFC. Again, you had a nice uptrend off the COVID lows. Big distribution. And you see this bearish continuation pattern now coming at the lower bounds or the breakdown level of this distribution pattern. It's like this thing's breaking lower, right? The path of least resistance for every one of these charts that we've just discussed is now lower. Fifth Third, no different. Right? You got the top completed. Nice little downside follow through. Bearish continuation. Looks like that is now resolving lower. How low can these things go? They could all blow up. We'll be like Canada, right? 5 or 6 big banks. Oh, well. U.S. Bancorp already backed down to these pre-COVID or post-COVID lows. Right? This was the COVID bottom from early 2020. U.S. Bancorp's a big one. Of all the super regionals, I mean, that would hurt. That would be a big one. This thing goes. Already lost more than 50% from its highs from early last year. Maybe not as severe of a drawdown as some of these other regionals, which are looking at 80, 90% drawdowns, right? But U.S. Bancorp down 50%? I don't know. So what's the takeaway? Can't touch them. Can't touch banks right now. Maybe there will come a time. Hope I'm interested again in banks, but right now there's nothing good about this sector. Nothing good. Even the big banks. Why am I not bullish on the big banks, right? The JP Morgans. You would think they're going to get new business. Their deposit base is only going to rise from here, right? They're going to have customers from other banks that are pulling their money, bringing money to them. Sounds good. They don't want it. Nobody wants to be in that business right now. If you have more deposits, that just means you need to figure out more ways to invest those deposits. And it hasn't been easy to do that, right? That's the problem that all these banks are having. They have deposits. Okay, we got to make more money on the deposits than we're paying on the deposits. That's why these banks are blowing up. They're having problems matching those durations, right? Maybe they're only getting 3% on their investment portfolio. They're paying 4% on their deposits. This is not a business that they want to be in right now, right? JP Morgan doesn't want that business to grow. So we'll see. The other problem I think that these big banks are having is they're being looked at as the ones who are going to pay for all this. We're going to bail out every regional bank that fails. Somebody's got to put some money in that insurance fund to pay for all this. Government's not going to pay for all of it. It's going to be the big banks, right? We'll take from the successful banks to support the rest of the industry. We've seen it before, right? This will be nothing new. So that's what I'm saying when I'm afraid, or that's what I mean when I'm saying I'm afraid that the entire banking sector are becoming regulated entities, right? So maybe they trade like utilities in the future, just with worse yields. I don't know. Somebody had an interesting take the other day too that I saw on Twitter, which was that in every financial crisis throughout history, Warren Buffett has been a buyer. Warren Buffett has been stepping in and taking big positions in these battered financial companies, whether it's Goldman or Bank of America. You know, he was making moves, getting warrants back during the financial crisis. Made some of the best trades of his career during financial crises. We don't see any activity from Uncle Warren these days. Uncle Warren's not dipping his toes in yet. I don't know. Maybe he owns enough. Thought that was interesting. Crude oil, 75 is the level. You know, we talk about these prior cycle highs in financials. Hey, look out. This could be a problem for energy. Energy looks so vulnerable here. Looks to me as though it's over for this group. I've said that before and been wrong. I jumped the gun last summer. I thought that was the end for energy then. These things have just been dead money for so long. Like, this is what energy stocks have been doing since last summer. You know, and this is the reason why I jumped the gun last summer, right? It's these prior cycle highs. When I saw them break, I said, uh-oh, that's it, right? And here we are again. These structures here can continue to look more and more like tops and less like continuation patterns or consolidations, right? This is equal weight energy. This is large cap weight energy. We break these prior cycle highs. It's really 78 in XLE. This is 78 right here. If that goes, I don't want any exposure to this space. It's been a great trade. We've made a lot of money on energy since 2020. I think that's coming to an end. All of these get broken together, right? So this is a situation where, as an analyst, what do we do internally? We make a list of energy assets. Okay, crude oil, heating oil, gasoline, large cap energy, equal weight energy, right? Even look through individual names, other indexes, oil services, explorers and producers. We have custom indexes that we're looking at. And we literally make a chart. Which ones are below the 2018 highs? Which ones are above the 2018 highs? And whatever list is longer tells us where the remainder are likely to go, right? We don't want to make the bet that, oh, XLE and RYE are going to hold their 2018 highs, but crude oil and its distillates or its derivatives, heating oil and gasoline, are going to violate. No, they're all going to go in the same direction, right? Some might be right and some might be wrong in the short term, but over longer time frames, all of these charts are going to look similar, right? So heating oil kind of making the first move, breaking those 2018 highs today. Crude, pretty much there too. I want to see crude take out these pivot lows, right, for confirmation. And if those things start happening, you know, and then, you know, these commodity futures, these energy futures are trapped below those former highs, then I would imagine that's where XLE and RYE are going also. When we look through the names that we have, you know, on our inside scoop list in the energy space, you're seeing very similar structures, right? So Pioneer, you could zoom out to the 2018 highs, and we're just kind of testing them right now, right here around 210. You can also zoom out to the all-time highs from like 2013, 2014, right? This is a big level. This was a monster base that looked like it was completing. Now it looks like it's failing. We're just seeing too much of this in the complex right now, in the energy complex. Texas Pacific Land Corp. Why did I bring this one along? This was a huge winner for us in 2020 and 2021. And we rode it to 2 or 3 price targets over the past several years. It's an almost 50% drawdown. This is the secular leader in energy, right? They're shooting the generals. The strongest stocks are faltering. They've been faltering. This thing's been falling since November. Like I said, been cut in half. Best stocks in the sector are down 50%. Usually doesn't bode well for the broader group. Oceaneering, OII, also a lot of this, right? These big bases, these real nice reversal patterns have been forming for several years now. Looked like they were going, a lot of them. OII is a great example. This is from oil services space. Massive fail. Below 18, you can't touch this. Below 18, it remains a mess. Above 18, sure, path of least resistance is higher. The reversal's in, right? New markup phase, new uptrend. Below 18, all bets are off. I don't want to touch it. Rig is one that's been, among the best performers over shorter time frames for energy. Oil services, really these offshore shale drillers have been doing great. But I mean, again, vulnerable here. We had this massive range and a really sweet breakout. When was that? Just early this year. Yeah. So this was just like the first week or two of January. Got this breakout here. And now this just looks like, multi-month top. So below 550, we're back in the box. This will be trendless and just more range trading, Transocean. I want to bring along a couple that are working, right? Because I know I sound negative, talking about all the damage in financials and energy and how these things could flow through and affect the broader market. And to be clear, energy is its own thing. I don't look at this price action from energy and say, oh no, the broader stock market could be in trouble. Not at all. Energy is going to do what energy does, right? And it has very little bearing or impact on the broader index and the broader market, right? It's really a commodity game. These companies are going to follow the price of crude, and you don't want to read too much into it. Some would even say energy is very defensive. Energy stocks tend to do well in periods when other stocks aren't doing well. And we saw that last year, right? So I'm not looking at the damage from energy and saying, oh no, the overall market. I'm looking at the damage in energy and saying, oh no, these former market leaders, I don't like them anymore. I'm looking at the price action in financials, right? And the technical damage in financials and banks and saying, oh no, the broader market. If this volatility, right, or this downside in financials doesn't bleed through to the broader market, it will be the first time. It always flows through. Not seeing it yet, but again, I'd be surprised if we put this whole regional banking crisis behind us and say, oh, broader market was fine the whole time. I think maybe we just haven't seen it yet. Anyway, Meta looks great. These growth stocks continue to look really well, trend really well. I like Google. We're talking about Google on our analyst meeting this morning. I think Sean just put an options trade on Google. I think Google will end up looking very similar to Meta and Netflix and other growth stock peers. But these are the ones we want to be buying, right? The ones that completed bases, unlike something like OII, right? Tried to complete a base, but still not getting it done. Looks like it's failing, right? Buy the growth stocks that look like this. Meta continues to work for us. We're looking for 300 in this stock. Hershey, how about these staples? Anything that touches sugar is just in a rip-roaring uptrend. Whether they make sugar water like Pepsi, new all-time highs, whether they make sugar food like Hershey or Mondelez, or if they make like poisonous beverages that will make your heart explode, like Monster, M&ST. These stocks are just screaming higher. They look incredible. If I had to put on my fundamental hat, I would say this is the market pricing in a resurgence in inflation. Why? Because these companies just wear inflation better than anybody else. They'll either put less food in your bag or they'll charge you more for it, but you're going to buy it anyway. These are grocery store stocks, and they are some of the best inflation hedges out there. You won't even know that they're doing it. You don't even know that you're paying more. What do you pay for Oreos? Right. So Hershey's looks great. McDonald's, I'm loving it. These are the stocks that are working right now. It is kind of defensive, gotta say. Staples have been leading, not aggressively, but they have been leading for 3 months now. 3 months of outperformance from Staples. Typically not bull market stuff. Again, it hasn't been big outperformance, right? But slowly just grinding higher relative to the broader market. We want to see things like discretionary and industrials outperform, right? Not the case right now. Maybe it's just healthy rotation. We'll see. This week's trade, we'll have a post out by it's already 1:30, probably tomorrow. But Skechers, SKX. I got Nikes coming in the mail right now. I keep looking out the window waiting for them. I bought 2 pairs of golf shoes because I have fat feet, and I'm worried that one pair won't fit me. But anyway, these footwear makers really working. Not just Skechers, but what was it? On. Yeah, that one looks good. Like that's a Swiss shoemaker. What is the one with Uggs is Deckers, DECK. Yeah, look at these charts. Full market for shoes, guys. I'm a buyer. Maybe not a Skechers stock. I'm really a Nike guy. I don't even know what shoes Skechers makes. They make like shoes for like restaurants and my grandpa. I don't know. I'll probably wear Velcro one day, but I'm not ready. So for now, Nike. If anything, I do like Deckers too. Deckers outdoor. Do love my Uggs. So Skechers, Deckers, Nike, on all these shoemakers doing really well. Skechers just a super clean chart right here, right? These are the kind of bases that we want to buy every time. Really clean level at these 2015 and looks like 2021 highs here. Call it 54.50 above there. This is a buy on strength setup. Where are we today? 54. Nice candle today of 2%. Maybe that triggers today. Listen, with today's candle, I would give this one my blessing right here. I think you could buy this strength right here. Maybe set a stop at that gap, that earnings gap. So I also love about this one is that earnings is behind it. We had a nice move on April 28th, so last Friday, big like 6.5% move. Maybe set the stop right there, right? Right at that gap called 50-50. I like that. Risking less than 10%. This one will pay you pretty good with a target of 77.50. Almost 50% of upside. All right, so that's all we got for today. Look out for a post on the website tomorrow about Skechers. Check in the chat. I don't see any questions. Hopefully I'm doing this right. Maybe you guys just don't want to talk to me. But as always, until next week, shoot us any questions to info@allstarcharts.com. And we'll be back here, same place, same time, talking about all the insider transactions of the trailing week again next Wednesday. All right, thanks everybody for joining me.